This is Rod Kusanen, Spoon for Risk. In this video, we're going to be discussing the automated Fibonacci extension lines. Now, if you have not reviewed the automated Fibonacci retracement line video, we encourage you to do so before proceeding. With regard to the extensions, once again, it is essential that we define our pivots. So using the same definitions for our retracements as we did with our pivots, we're going to proceed with this discussion. Our pivots are based upon a 15 and a right strength of 10. That's both for the low as well as the high pivots. Now, when drawing an extension, unlike retracements, extensions require 3 pivots: an A, a B, and a C. So for example, if we use this as point A, move up to a high pivot of point B, and a higher low pivot of C, we get an extension upward. Now, according to this arrangement, point A will always be lower than point B, and it will be lower than point C. Okay? C will be always higher than point A, but lower than point B. So as the market is moving up, we're looking for an extension up, and basically this is the configuration that needs to take place. Now, if point C were to drop below point A, it would invalidate the setup. So we would essentially start over in drawing the retracements. We'd have to look for a new setup if this were to occur. On the other hand, if the market in fact moves higher than our 100% line, we have elected to begin a new setup. Now that's the decision that we made when we created the tool. There had to be some way to make a determination as to when we would start a new setup, and so we have 2 provisions. One, if point C drops below point A. Number 2, if the current bar exceeds the 100% extension line. So if we were to move above this line here, we would start a new setup. As it was with our retracement lines, when drawing these historically, we simply need to turn on the advanced commentary function, which has already been turned on in this particular case. So we'll just go ahead and proceed. So we turn on the indicator and we set up the extensions here. We define our left strength, our right strength. Point C has the same left strength as point A and B, and then the right strength of C is set to 2 so that we can recalculate quickly. In this instance, we've also set up the drawing of the extension lines so that no down extension takes place. We're setting the down color to the background color of the chart. Now, there's one other aspect to this that we have not mentioned previously. There needs to be at least a minimum distance between point B and C in order to draw the lines. This minimum is expressed in the actual number of what the point spread is between those 2 pivots. In this case, 2 means 2 points or 8 ticks. The same would apply to retracements, shown here. So that's another variable built into the automated Fibonacci retracements and extensions. So now when we move forward and actually begin to draw the extension, we crudely drew this extension based upon an estimated low of point A, an estimated high of point C, an estimated low of point, let me rephrase that, an estimated low of point A, estimated high of point B, and an estimated low of point C. But the Fibonacci retracement tool that we create does this exactly. So once we've passed this pivot, it will automatically draw our extensions exactly. If we go above the 100% line, the setup is discontinued. Now let's recalculate here. We've got an A here, a B here, a C here. We've gone above the 100% line, and now we're looking for a new setup. Well, the next new setup would be based upon this point A, this point B, and this point C. So now let's draw that manually and then draw it automatically. Here's A, here's B, and here's C. The automated tool, all we need to do is click a couple of bars past C, and it's automatically drawn for us exactly where the lines need to be. Again, it will look back based on our definitions and identify the exact price of our pivot points when it draws the line. Our rule, once again, if we go above the 100% line, we recalculate. So over here, that line would disappear. It's really that simple. So the two primary rules that you need to keep in mind when drawing extensions: if point C were to drop below point A, it will cancel out the setup. And if the current bar moves greater than the 100% line, it will also cancel the setup. So when I said point C here drops below point A, I'm meaning that the current bar has actually dropped below this point A. Let's look at an example of this. If we use this as our point A, this is our point B, and this is our point C, we'll be able to run an extension. If the current bar drops below C, as it does here, and let's get it a little bit further on, it'll recalculate again. As long as the current bar does not drop below point A, we'll continue to redraw the lines. But as soon as it drops below that level, which it does over here, it cancels out the setup. This happens when we draw the extensions historically, but it will also happen when trading live in an automated setting. Let's now look at the down extensions. So that we just have the down extensions being highlighted, we're going to go back into the indicator. We're going to change the up color to the background, and the down color, we'll use this to show up. So what it did in this case, it found the most recent pivot. Here's a high pivot, a low pivot, and another high pivot. Here, here, and there. So now what's the rule? We'll cancel this setup if the current bar moves greater than point A or the current bar moves below the 100% line. We'll also recalculate if the current bar moves greater than the previous point C but remains less than point A. We don't see a real example of this happening until over here. Okay? We've moved higher than the previous point, so now we'll simply redraw. Let's get the thing turned on. There we go. We're going to redraw that extension here. We'll redraw it again and again. But bear in mind, our A is way up here, 1249. So if we go higher than 1249, we'll ultimately need to cancel that setup. Hasn't happened yet, but we're getting very close. So right here, we're going to cancel this setup because we're now greater than our original point A. Now we've got another situation here. We've got a point A, point B, point C. We can have a down extension. But if we go above this point A, it'll cancel out that setup. So we want to keep in mind that's how this automated tool works. Let's now look at our extensions from the context of whether there are any existing gaps. We've had a very nice move up in the market. The market is closed on Friday, 12/23/2011 after just hitting a high of 1260.75. And we're wondering whether or not we're going to get an extension down. Well, right at this moment, we don't have sufficient data to make that projection. But what we do know is whether there are any gaps below the market. In order to get a true picture of whether gaps exist, we have to go back to an existing low. The low that occurred on 12/18, right in here, pardon me, that's 12/19. We would now want to look to see whether we have any gaps during the day on 12/20. Now the easiest way to find that out is to simply go to our 50 share bar chart and use just a couple of days looking back historically. So what we'll do is we'll go to our format symbol and we'll find the date of 12/20 as soon as it comes up. And we'll just go back a couple of days. Now keeping in mind this is a 50 share bar chart, so there's going to be a lot of bars on this chart. We don't want to add too many bars on the chart to check for gaps because that will in fact require quite a bit of data and it will take quite some time to load. So we'll just set it up this way. And using a relatively powerful computer, this will give you an idea of just how much time it takes to load this chart. Now you're going to do this historically, so time is not that critical. So what do we find? At the close of this particular day, there were several remaining gaps. One at a price of 12.30.25, another at 12.15, and a third at 12.10. So now when we go back to our chart here, we know that there are gaps as far down, at least at this time, as far down as 12.10, and another one at 12.15, based upon where the market was starting on 12.20. Did the market go any lower than this? If we go back far enough, let's just create a trend line. We'll extend it to the left, and we'll just move back until we see where the market dropped, in fact, even further. If we go all the way back to 11:30, we see that the market had dropped even further. Now let's see if there's any further gap information, and yes, there is. All right? We could go back all the way to 11:25, where the market had dropped even further. So what we need to do in order to determine if there's really any gaps is go back to the same period of time and see where the gaps occur. Now, bearing in mind that this is, in fact, a 1,000 tick bar chart, there was a huge gap between the open here and the previous close right around the Thanksgiving Day holiday. Traders should be aware of that, because the market will fill this gap, and that's a big one. That's a big one. So regardless of where the market is going, I'm afraid to say that that gap has just simply got to be filled. That means that the market needs to drop to where the gap started, which is at approximately 11.48 1/4. That doesn't bode well for a rally. But you got to keep that in mind. Okay? You definitely have to keep this in mind. So what we'll do now is we'll go back as far as 11:25. We'll start at 11:30. We'll take it back 5 days from there and see where our gaps occur. So now to do that, once again, we go back to our 50 share bar chart. And what I'm going to do is I'm going to take our gap finder and I'm going to turn it off. I'm going to turn the gap finder off. And first of all, collect my data. So in this case, I'll go back to the 30th of November. As soon as this pops up. And I'll take it back 6 days. Now I'm going to grab that data, and once it propagates, then I'll turn my gap finder on. All you have to do is simply turn it on, and it will find all of the outstanding gaps. Now that's 6 days worth of data, and this may take just a little while for it to run through every single bar and look for any instance of a gap. So logically, this is going to take just a little while, but not that long, as you can see. Okay, so the lowest gap that we see here is at 1148, and where did that occur? We can just scroll to the left, and there it is, right there, that big gap that occurred during the Thanksgiving Day holiday. You can anticipate that this market will need to fill that gap. Now, this video, incidentally, is being created on the 26th of December of 2011. So are we suggesting that this market's going to drop? I'm not suggesting anything. I'm just telling you there's a gap down there. I'm also suggesting that gaps are always filled. So you make up your own mind as to what's going to happen here in the foreseeable future. Can we say when gaps will be filled? No. That we can't say. But the probability that they will be filled is very, very, very high. Could the market continue to rally up during the last week of the trading year and perhaps all the way into the month of January of 2012? Absolutely. Most certainly could. But eventually, this has got to come back and fill this gap. So, it'd be very important to watch the market closely, as these gaps will eventually get hit. Mark my word. Now, keep in mind also that we have gaps at 2275, 18, 1204, 1201, 1188.50, and so on down the line. So we've got a lot of gaps that have got to be filled here. Now, what has that got to do with anything? Well, remember, we're looking for projections, extensions down. While we do not have the data as of this time to run those extensions, because in order to get that data, we've got to have a low pivot, a high pivot, which we have at the moment, but we don't have another low pivot, a point B, and we don't have a point C. So we really can't run the extension. But bear in mind, this is where the gaps are. And this will ultimately wind up being a very huge, huge extension down. Knowing where the gaps are in conjunction with the extensions can give you a high probability of where the market will go, where it's liable to pivot, where you may want to take profits if you're short. And all of that data can be instantly accessed by the use of the gap indicator and our automated Fibonacci retracement and extension tool. Now, just one last word about extension calculations. This may be obvious to most of you, but in case it's not, let's just go through this exercise. When we do an extension, again, we find a point A, we drop to a point, in this case, we're looking at an extension down. a high point A, low point B, high point C. This gives us an extension down. The 100% line seems to be significant. Now, that 100% line is not always hit, but frequently it is. The golden ratio is often hit as well. But now here's how this works. It's very simple. You go from your point A to your point B, whatever that distance is, and let's just say hypothetically, again, hypothetically, let's just say that that's 10 points. So this distance from here to here, let's just say, for simple figuring, that's 10 points. Now we go up and we find our point C. We're now going to calculate an extension down. The 100% line will be 10 points from point C down, because that's 100% of the previous move. So any ratio in between is based on the ratio between point A and point B. That's how extensions work. But notice they also seem to be significant. That little move brought us to an extension down here at about 1196. Sure enough, it hit that number, turned right around, started going back up. So keep in mind, this is how it works. And obviously traders realize this and make use of that data. So it's good to know. And once again, if we have gap data that will help us to make that call, we'll be in a slightly better position to know where the market is likely going to go. So now you know a little bit more about extensions and retracements than you did before. Our tools are automated. There's no guesswork involved. The only thing that the trader needs to do is define his pivots and then let the tool do the rest. This is Rod Kusin and Spooman for Risk.